Are you guys selling an investment property soon? Stay tuned to find out how you can defer all sorts of taxes like capital gains taxes and keep more money in your pocket for your next deal.
Boom! Here with Kelsey over at Midland, and we're going to talk details on selling investment property and deferring the taxes. I mean, let's face it, nobody wants to give unnecessary money to the government, right? So we're going to talk details on that. Appreciate you joining us today.
Awesome, glad to be here.
So what is a 1031 exchange?
So a 1031 exchange is basically an old school tax rule that a lot of investors know about, but you don't hear about too often until the market starts going up a lot. So when you sell a property, an exchange is basically where you take the sale proceeds from the property you've sold, you have to park them with an intermediary so you don't touch them, and then you just take that money and you can reinvest it in more property. And as long as you do it with an intermediary and you follow the rules, you don't have to pay taxes on any of the gains that you had. So think of it as, I've got a real estate portfolio. I want to sell one of my properties to get into a new upcoming market or a different property, but I know if I move the money, I'm going to pay taxes on it. A 1031 exchange is basically a way of letting you move cash around and get into new properties without paying taxes like capital gains, depreciation or capture, all those sorts of nasty things that come into play.
Oh, I've been there. I've been hit pretty big. So what are the rules associated with it? This has to be investment property?
Has to be investment property. So it could be any type of property. So it would work for vacant land, commercial buildings, single family. And that's a big misconception some people have, is they think it's only for like really big commercial deals, when in reality, you need to do a 1031 exchange if, number one, you're looking to sell a property like investment property and get into more investment property. And number two, if you think that you're gonna have a big capital gains tax or depreciation or capture tax. As long as those two criteria fit, I wanna sell investment property and buy more investment property, and I know I'm gonna have a big tax bill, then a 1031 exchange probably makes sense for you, regardless of how big the property is. Right. So it has to be investment property, can't be a primary or secondary residence. It will also work for business property. So Steve, if you ever go out and buy yourself some, commercial business space to operate the company out of, and you decide for whatever reason you want to sell it and maybe roll the money into rental properties or more business space, you can do that, and the 1031 will let you do it without paying taxes when you sell the old property.
Interesting.
So business or investment.
So let's paint the picture. So let's say I have a fourplex and I own it for, let's say, a year and a half, and fixed it up, significant equity. Let's say there's $100,000 gain on it.
Sure.
What's the process? What do I do?
Sure. So first thing is, if you're doing flips, so let's say you don't hold it for a year and a half. Let's say you only hold it for a month and you're flipping properties, a 1031 won't work for you there, because then it's considered inventory, not necessarily like long-term, what they call productive use property. So flippers, I'm sorry, I'm not gonna be able to save you the capital gains tax. But if you're doing longer term, like let's say a year and a day to 2 years, and 2 years is actually what the government says is their safe harbor rule. I'm doing a lot of quotations. The government's very quotable. It's their safe harbor rule. So after 2 years, they won't question it, essentially, as long as you've held it for investment. So I basically decide to sell my property. I go under contract for the sale. A lot of contracts, especially like the as-is contracts, already have 1031 language in them. So if you kind of scroll through your contracts that you use, you're gonna see 1031 or like-kind exchange. Those are the terms they use. It basically says the contract can be used for a 1031 exchange. The reason it's built in is because so many investors do it, because it makes sense not to pay the taxes and basically defer them. So your contract says you can do it. Before you close on the sale, that's when you have to have an intermediary involved. So I usually get a call as soon as you go under contract for your sale. You say, Kelsey, I'm gonna be selling in a month. Here's a copy of my sales contract, and we will actually contact your title company or attorney who's doing your closing and make sure they know you're doing an exchange.
Got it.
The reason why is your closing documents, so your settlement statement, stuff like that, it has to show that there's an intermediary involved.
Got it.
The government hates it if you take the money personally. If you take it personally, you gotta pay taxes. You've touched it. The only way to really avoid that is get the intermediary involved before closing. The title company will show that an intermediary is involved. All the sale proceeds, instead of going to you personally or your bank account, they're going to us. So we're like that middleman. We park the funds for you.
Got it.
And then it's just a matter of you going out and finding your new investment property. So
Okay.
once you find it, exact same process. You send us a copy of the purchase contract, you let us know who the title company or attorney is who's doing your closing, and we actually release the money straight to the title company or attorney to purchase the new property. So the
Okay.
money never touches your hands.
So I buy a fourplex,
Mm-hmm.
I sell it close to 2 years or whatever the case is. Let's say it's worth a $500,000. I have a $100,000 gain.
Mm-hmm.
Now, do I have to buy another multi-family property? Does it have to be one property? Can it be multiple properties?
Good questions. So the government doesn't care how you split it up. So you could sell 5 properties and buy one, or vice versa. You could sell one, buy 5. They don't care about how many individual properties you're buying or selling. What the government cares about is what they call the net selling price. So the old property that you sold, sales price minus closing costs, that's what you have to spend on the new property or properties, whatever you want to
Got it.
buy. So as long as you're basically spending the same amount or even higher, if you go above that, that's fine. You're not going to pay any taxes. It's only if you start downsizing that you're going to have to pay taxes on the difference.
Got it. That makes sense.
Yeah.
And I know there's timelines associated with identifying the properties.
Yes.
Can you cover that?
Yeah, so timelines in a 1031 exchange, that's the hardest part of this
Yeah.
process. So the clock doesn't start ticking until you actually close on your sale. So you close on your sale, the clock starts ticking. You have 45 days from that date of closing to identify what you might purchase. Identify just means I give you a piece of paper and you write down 3 possible properties you might purchase, right? So you identify 3. By day 45, you have to lock in that identification. You can't change it anymore.
But I don't have to buy those 3 properties. If it's just one of the 3, that's it.
Exactly.
As long as I close on at least one of them, I'm good.
Exactly. So let's say you do the easy example where I'm just identifying 3, my plan is to buy one of them, right? You have to buy one of those 3 by day 180. So those are the 2 timelines you have to remember in a 1031 exchange. 45 days to identify, and then 180 total, again, from the date of when you closed on your sale, 180 days total to buy one of those properties.
Got it.
And then if you do it, you've deferred your taxes. And again, I say deferred. It's not like the tax bill evaporates. It's instead of paying the taxes now, I get to hold on to that money and reinvest it. And I kind of call it like an interest-free loan from the government, right? Like if you're gonna pay $50,000 in taxes, but by doing an exchange, you can hold on to that 50 and reinvest it in more property. That's great. And you don't have to worry about paying that tax bill until you finally sell that property and don't do a 1031 exchange.
Got it.
Some people keep on doing exchange after exchange their entire life, and hopefully they never pay that tax bill.
Right. Interesting. So what are the taxes that are actually deferred?
Yeah, so a 1031 exchange, most people just think capital gains. I bought it for so much, I fixed it up, it's now worth a lot more. When I sell it, I'm paying capital gains tax. So a lot of people default to, capital gains tax, but it's actually a lot more than that. So capital gains tax will be deferred. You also can defer depreciation or capture tax.
Oh, nice.
That's a big one for buy and hold guys, right? Because the longer you hold it, the more you depreciate it over time.
Right.
When you sell that property, if you've been depreciating it over time, which a lot of people do so they don't have to pay taxes on their rental income, when you sell it, you have to basically recapture that depreciated income. So it's 25%. So if you've depreciated, you have a quadruplex, you've depreciated $100,000 over the years you've owned it. When you sell that quadruplex, it's not just capital gains tax, it's also $25,000 in depreciation or capture tax.
Wow.
That's a huge hit for a lot of people that they didn't see coming. So luckily we're in Florida where we don't have state tax, but a lot of people who are selling properties up north and retiring and moving to Florida, if you're in a state that has state tax, you also get hit with state tax. So a 1031 exchange basically lets you sell a property in a state that would have state tax, defer the state tax, and get to move that money to a different property. And it could be anywhere in the country. You could sell a property in New York and buy a new property in Florida, or maybe sell a property in California. They have a lot of state taxes, right? And not have to pay it and have more money to reinvest elsewhere in the country. So we've got capital gains, depreciation or capture, state taxes, and then for some really lucky folks out there, there's a 3.8% healthcare tax. So when the whole Obamacare thing was happening, they had to figure out how to fund certain aspects of it. They installed basically a 3.8% healthcare tax on certain high net worth individuals. So depending on what your income is for the year, you might have to pay that on top of all the other taxes.
Great point. I didn't even think about that.
Yeah.
And I would say also, don't get wrapped up in terms of thinking that this is confusing or hard to work with, because it really isn't. Also, don't worry about the timelines in many cases as well. If you're selling your property, if you get with a good real estate company, a good real estate broker, they're going to help you find and identify that next property in a timely manner. So I wouldn't allow necessarily the time frame to stress you out too much either.
Yeah.
If you guys got some good information out of this, we appreciate you liking and subscribing to the channel. If you have any questions, further questions about 1031 exchanges, comment below. So we appreciate the support, and thanks again for coming out.
Thanks for being here.